and we'll officially get started. So I want to thank everybody for joining us today. I'm really excited. We've got Dr. Byungwook Kim here today. He's an assistant professor of finance at the Merage School of Business at the University of California, not San Diego, University of California, Irvine, UCI, so about an hour up the freeway from us here at Rady. His research interests include asset pricing, investor behavior, asset management, and fintech. So I think he'll be a perfect fit on our call today. And demonstrating the merit of his work among practitioners, he's been featured in the media, including Bloomberg, The Economist, Financial Times, Reuters, and the Wall Street Journal. Dr. Kim earned his PhD in finance from The Ohio State University, an MS in statistics from the University of Chicago, and a BBA from Yonsei University in Seoul. So he joins us today to walk us through his Brandis Prize finalist paper, Do Share Repurchases Increase the Value of Non-Repurchasing Firms? And with that, Byungwook, I will turn the floor over to you, my friend.
Thank you very much for a nice introduction. So may I share my screen too?
Yeah. Hopefully I
Right,
set
sure.
this up
Yeah.
so you can do that.
Okay. Can everybody see my screen? Well,
It's coming up.
yes,
Yes.
great.
Now we see
Okay.
it. We're looking good.
All right. Okay, I don't see it actually. Okay. Uh,
I can help you. Got the title slide here.
my screen. Oh yeah, I see. Can you everybody see it?
Yeah.
All
Yeah.
right, great. All right. All
Looking
right.
good.
There's a bit. Okay, so thank you again for interest in my work. I'm very excited to be here. And again, my name is Byungwook Kim, and I'm assistant professor of finance at UC Irvine. I'm very excited to present this paper about share repurchases and looking forward to your comments and feedback. So to start, I want to talk about the structural change in the way firms distribute their excess cash to investors. Uh, it's been well known that share repurchases are becoming increasingly important in the US. As you can see from this figure, I'm plotting nominal dollar amount of repurchases versus share issuance versus dividends. You can see that the amount of repurchases has been very big. In 2023, for example, the total amount of share repurchases was over $1 trillion in the US alone. And the amount compared to dividends, if you can see as a percentage of the total stock market value, you can see that it's almost double the dividend. And if you think about, well, you have to also account for share issuance because what really matters is net buyback. Okay. But if I compare the amount of repurchases to share issuance, you can see that they are typically very small. And the only time the amount is greater than repurchases is during bad times. For example, in early 2000s, global financial crisis and around COVID. Uh, and also, another thing we can learn from this chart is that dividends used to be much more important in 1980s and 1990s. But starting from 2000s, dividends are much smaller, very smooth over time. And also you can see that repurchases are much more volatile and highly procyclical, actually. So for example, from in 2000s, early 2002, right before the global financial crisis, he went up sharply, and went down, he went up again, went down during the COVID, and it's going up again recently. Okay. And by the way, if you have any questions, feel free to jump in, and I'm happy to answer any questions. And I also sometimes leave the floor open to questions as well. So yeah, so this has been the trend, and of course it has been noticed by many people, and especially politicians, regulators, and the media. For some reason, many don't like repurchases. I think maybe there's the sheer amount sort of scares people. And the typical narrative many people have in mind is, okay, so, well, this is a lot of money. Okay. So this amount of cash get distributed to shareholders. Well, and shareholders are very wealthy people. Okay. And I don't like that. So they're already living a good life. Okay. And if they get this payout distributed, then they will be able to consume even more. And then they can even maintain a more luxurious life. Um, so they don't like, yep. Uh, and this is concerning to many people because uh, people believe that the capital could have been used more efficiently. For example, people think, okay, so maybe this amount could have been used as investing more in CapEx or R&D, or firms could have treated employees better. And all that could benefit long-term economic growth than just distributing cash to shareholders. People think that these payouts are benefit wealthy people in the short run. Okay. So they tend to think that this happens at the cost of long-term investment or something that benefit the aggregate economy in the long run. Okay. And I myself, like personally, don't necessarily agree with this type of debate. But I'm not going to talk about the whole issue. I'm just going to take this trend as given. Okay. And I'm just going to tackle one assumption underlying this debate, which is, okay, people think that cash get distributed to investors, and they think that investors with this cash will consume more. So people think that this payouts from buybacks, okay, will incur outflow, okay, from the financial sector, okay, or financial markets, okay. But it's an open question of where does the cash distribution ultimately flow, okay? The question is to pockets of investors, okay, or do investors reinvest the proceeds to other asset classes, or do they reinvest the proceeds back to the stock market? Okay, that's the open question. Okay. And what I find in my paper is that cash distributed to share repurchases ultimately flows back to the stock market. Okay? And I study one interesting implication of this phenomenon, which is it means inflows to those firms that do not engage in buybacks. And I find that those inflows generate price pressure on non-repurchasing firms. Okay? And why does it happen? So you can imagine that share repurchases are not visible in real time because whenever we trade in the stock market, sometimes we sell and we never know that whether the buyer is firm or other investors. Okay? And we only know that firms buy back when they disclose that they buy back X amount of money, okay? X amount of shares. Okay? So investors are just naturally trading in the stock market. They're just rebalancing portfolios for their own needs. Okay? And if you think about institutional portfolios, I can give you one specific example of institutional portfolios, say pension funds. Okay? We know that many pension funds have target allocations, say like 50% in stocks, like 30% in bonds, maybe 20% in alternatives. Okay? So it means that these shares are rigid over time. So any portfolio rebalancing, okay, doesn't incur like flows across asset classes like drastically. Okay? But there are a lot of portfolio rebalancing within an asset class, for example, within the stock market or within bonds or within alternatives. Okay? So whenever pension funds sell and when firms are buying back, okay, it means that most of the proceeds will be recycled within the stock market. Okay? And for that reason, there's law journal like Booth arguing that 95% of distributed cash from buybacks get reinvested in the stock market, but with no empirical evidence. Okay? Uh, if you, and also another reason for that is, okay, even absence of this, target allocation, okay, if you think about the reason why people invest in the stock market, okay, there are many reasons, but one important reason is to earn the equity premium, okay. So US stock market is very attractive in terms of that. Okay. And there are not many alternatives. Okay. So maybe there are emerging markets or European markets, or maybe there are other asset classes, but US stock market is quite special, I'll say. Okay. It has consistently performed very well. Okay. So if I sell Apple, for example, okay, I want to buy other stocks, okay, that reinvest the proceeds into like bonds or some other asset classes than stock market. Okay. And if you think about this mechanism, and if you think about one important additional piece, which is firms buy back using their cash holdings. Okay. And if you think that investors reinvest the proceeds into the stock market, okay, some of this reinvestment will flow into non-repurchasing firms. Okay, it means that for those non-repurchasing firms, there is cash ingestion, okay, to their shares. Okay, there are inflows to other firms. Okay, and if you believe that flows move prices, then we could imagine that the resulting flows can increase the aggregate value of the portfolio of non-repurchasing firms. Okay? And it can happen because buybacks are so large. Okay? If you believe that most of the proceeds get reinvested in the stock market, okay, the resulting flows will be very big. Okay? That's basically what I find. Okay. So I think that's everything about my paper. I have one additional interesting piece about the value premium, but I think this is a good time for me to pause and like check whether you have any questions at this point.
Okay, Jung, thanks very much. JJ, you got your hand up?
Yeah, I do. And this may be somewhat of a naive question, but I'm curious if you have ideas of what motivates a firm to buy back or not. I mean, is it really driven by excess bundles of cash? Or, I could think somewhat devious of, oh, well, there's a high level of executives inside, and from a pricing beneficial standpoint, is there something going on? I'm just curious what anybody thinks, really.
That is a great question, and financial economists have been long thinking about what really drives buybacks or payouts in general. But if you think about um, in the context of buybacks specifically, yes, excess cash should be a big motive. Firms have excess cash; they don't have anywhere else to invest, so they have to distribute. This is corporate finance 101 type of answer. But but I think you're right. We've been thinking about these motives of how executives get paid. For example, their compensation is tied to EPS. Okay, and we know that a lot of salaries, not salaries, but a lot of compensation is paid through stock compensation, not only to executives but also to just employees. Okay, and those tend to actually dilute shares, which actually means lower EPS. Okay, and whenever that happens, they always have an incentive to boost EPS. Okay, so people have been saying that okay, so maybe starting from 2000s, there has been rising share of stock compensation, okay, which has been diluting shares over time, and maybe that's one of the reasons why buybacks have become more popular than dividends. That could be one reason, I think. Yeah, that's a great question.
Can I ask you, first of all, of course, it's a great paper, so thank you. I was just wondering, you write quite a few things about why this is not arbitraged away, and you said this is sort of a macro trade. So I was just wondering if you could add a few more comments to that and why you think that smart hedge funds are not picking this up, because I guess if there is a thing to be picked up here, somebody will probably try to do it, right? So why is that not happening? Can you probably put a few more words on that, please?
Yeah, that's a very fundamental question. So yeah, so if that happens, somebody should be taking advantage of it. In the paper I mentioned, for example, Xavier Gabay and Ralph Goyen's work, they thought about this whole issue about why this aggregate flow into the stock. So they find that aggregate flow into the stock market, $1 inflow raises stock market value by $5. Okay. And then they ask, okay, so if there's such a big amount of change in stock market valuation, why don't hedge funds trade on it? Okay. And then what they find is that there are not many hedge funds or smart players that actively trade across asset classes. And we don't know why, but many are very specialized, okay, within an asset class or very specific setting, okay. So it's empirically, if you find like institutional portfolios data, it's hard to observe who like pull out a lot of money from the stock market and invest in bonds or other asset classes. That kind of behavior is very rare, okay. And so for that reason, within the at the stock level, if one stock gets mispriced, somebody can sell other stocks and take advantage of it. So at the stock level, this type of mispricing is less severe, I would say. Okay. But at the aggregate stock market, for someone to fix this, somebody has to be very aggressive in the sense that they have to pull out money from the stock and then reinvest the proceeds into other asset class. And that type of behavior is just very rare, surprisingly. Okay. So I guess maybe that answers some of the question, but I don't know why that's the case. Yeah.
No, but that's
Yeah.
thank you.
Mhm.
And then the second question for me was just implicitly, I assume the conclusion also goes for dividends, right? Because that's another way of distributing money. But just your thoughts on, is the effect as strong, or sort of can you put a few more words on that? Because that was also tricky for me to pick up.
Yeah, so that's a good question. So there is a paper about that that is published in American Economic Review by Sam Hartzmark and David Solomon. They look into mechanical dividend reinvestments by investors, and they find that $1 inflow raises the stock market value by $2. And that's actually, I would say that's a cleaner setting than mine, because for dividends, everything is observable and predictable. And even then, they find that dividend reinvestments, $1 dividend reinvestment in the stock market, increase the aggregate market value by $2. And so that's the magnitude is smaller than what I document. And I think that makes sense because everything is predictable there. For me, it's not predictable, actually. It's not really observable. So I can argue that so magnitude should be bigger than their setting. Thank you.
That makes sense. Thank you.
Rhonda.
Just a quick follow-on question from that then. Would you guess, are there any sector impact, certain sectors, therefore, where you see this phenomenon more strongly? And then I know it's beyond the scope of the paper, but any performance indications traditionally, right? It also is seen as a sign of confidence, management buying back shares, but does that really hold any longer, you think?
Across the sectors, yes, and I'm going to talk about it a lot actually in the remaining of the presentation. So just to give you a heads up, like the buybacks have been driven by tech sector and pharma sector in 2000s and 2010s. And I will show you some interesting implications on the performance of value versus growth firms in that regard. Yeah. And I missed your second question. So managerial confidence, or I missed that, sorry. Could you
Well, that
repeat
would really, the performance of the value versus growth firms would answer it. So,
Oh, okay. All right, great. Yeah, I'll
That's-
get that. Yeah.
Thank you, Rhonda. Hey, before we jump into that, because Byung, when you mentioned value premium, I think everybody kind of went, "Ooh, hey, there's more to come here." I just want to circle back a little bit on why this may be happening, and I'm thinking about it because I looked at Christian's paper and our summary of that earlier this morning. And Christian, if I can pick on you to jump in here and see if you would agree if I've got this right. Given the flows to passive funds, we're seeing increased beta, particularly for small and mid-cap firms. So this is kind of artificially maybe increasing their cost of capital. So if you're looking at a project to do, I'm not going to do it. And maybe I take the route of a share repurchase program. Does that kind of summarize your work?
Yeah, that describes it pretty well. Byungwook also knows the paper very well. He was a discussant at a conference.
Okay, small
Yeah.
world.
Yeah. 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 We talked about the paper and exchanged multiple emails. So yeah, very nice work actually. Yeah.
Okay.
Yeah.
Here, I think I'm adding something new, and you're like, we got that, Bob. Thanks. So any other questions thus far? The only other one that I had, and I was thinking about this as you were talking, have you looked at announced buybacks versus executed buybacks? In my sense, companies may announce this stuff and then not act on it or not act on it fully.
Yeah, that's a very nice question. So not for this paper. I have experience looking into buyback announcements. But I can tell you some papers about it. So it's true that like these firms announced that, hey, we're gonna buy back maybe $20 billion amount of share over the next 5 years. Okay. And it's not a promise, right? So typically they do, less than that, right? And I think what's really interesting is investors don't seem to realize it that much, and they don't seem to penalize it, unlike dividends, because like investors, would hate the behavior if that happens around dividends, right? But they don't seem to care about, buying back less than what is promised or not. Yeah, so it's interesting. Yeah.
Yeah.
And I think that also speaks to the earlier question why buybacks are becoming more important, maybe because of this feature. So, like firms can be more flexible in terms of paying out. Okay. For some reason, investors are razor focused on dividends, like how much they get paid. Okay. But for some reason, they don't for buybacks. So maybe firms like buybacks for that reason too.
Yeah, we can dig into that a bit more. JJ, any other thoughts?
Just another question, maybe this will actually come into more of the presentation, but any relationship between firms putting their own cash into their pockets, buying back the stock, as opposed to investing in R&D or maybe being more acquisitive and buying another company? Just any insights?
So I guess your question is, okay, so if they buy back, what does it mean to other firm outcomes? Was it your question? Oh yeah. Yeah, so I have the slide, but I can tell you that buyback firms are typically large firms, very mature firm, old, and they have a lot of excess cash flows. So for that reason, they don't have a lot of investment opportunities like R&D and CapEx. So they typically invest less in R&D, for example. But there's actually an interesting paper by Hector Almeida and his co-authors saying that for that EPS-driven reason, sometimes firms forego future investment, okay, because they want to buy back their shares, get to boost their EPS. And they actually present the causal evidence of that. Yeah. So
Okay, Young, thank you.
yeah.
Hey, I think we're all excited, or maybe I'm projecting here. Talk about the value premium. Can you jump to that?
Sure. Oh yeah, happy to. Okay. So here's the value premium part. So we know that many investors operate with some investment styles, right? Cap-based or growth versus value. Some investors focus on specific industries or sector, right? Okay. And naturally, you can imagine that because let's say today, Apple, okay, is buying back a lot of shares. Okay. Like Apples are widely held by investors, so many, across many investors, there will be selling behavior. Okay. But if you think about Apple, it's a firm characteristic. It's a tech firm. Okay. So it must be that like those okay, focusing on tech firms are selling more than those focusing on, for example, like oil industry or banking sector, right? Okay. And if you imagine that, yeah, and if you believe in this portfolio rebalancing behavior, okay, those focusing on technology firms, okay, will be probably reinvesting the proceeds to other tech firms. Okay. So you mean that when Apple buys back, okay, Microsoft or like Nvidia, other similar tech firms will be experiencing increase in valuation. Okay, and it's bad news for value stocks because relatively speaking, growth firms prices will be rising more than value firms if that's the case. Okay, so what I find that recently, so I'll show you the chart. I'll jump to that part. So if I look at across different firms, what I find is that, especially recently, buybacks have been driven by large growth firms, like tech firms. Apple has been a very big player, and also pharma firms have been big players. Okay, and if you think about the value firms buyback, okay, it used to be actually bigger in my early period, but they're actually very tiny. Okay, and I can also show you a list of top 10 buyback firms. Like, for example, here, this is a snapshot as of 2015. Okay, you can see that those buying back, okay, Apple is a huge buyback firm. Its share repurchases was $36 billion in 2015 alone, which accounted for more than 7% of the total buyback in 2015. Microsoft, okay, other tech companies, okay. So you can see that, recent buyback boom has been driven by those companies in a very specific sector or industry. Okay. And if you believe in this style aligned portfolio rebalancing, okay, you can imagine that, okay. So this is like pharma French style, classification of stocks. Bottom, small, top, big, left, growth, right, value. You can imagine that inflows, okay, will be much greater, okay, than inflows to growth firms than those to value firms when growth firms are buying back their shares.
Yeah.
Okay. Yeah. And was there any question or?
No, that's
Okay.
helpful because if I'm hearing you correctly, you're
Mm.
looking at kind of the classic definition of value here, of
Yes.
the market measure. And I only bring that up because a couple of weeks ago, hosted yet another webinar, and we'll host another one in June. And with some value investors, the definition of value has shifted. They're looking at companies like Google or even Nvidia and saying, that's actually a value firm because its price now is lower than, the value that it's going to deliver in the future. So again, for your work, more of a classic definition of
Right.
growth. Got it.
Right. And I'm glad that you mentioned those work. I know one of the papers, but I think Andre Gonzalez had once presented his paper here about fundamental to something ratio. I forgot the exact term, but I think the argument was similar,
Yeah.
saying that, yeah, actually some of the tech firms should be classified as, the value firms. So value premium is actually not as small than you think. Yeah, that's actually cool. Yeah. So you're right. So I'm focusing on like a traditional classification, like found French style, 1993. Yeah. And so you can imagine that, like, again, inflows will be bigger among growth firms. That's exactly what I find. So for now, just ignore this term GIV. This is just, you can think of this as repurchases by value firm minus repurchases by growth firm. Okay. And I look into flows into value firms minus growth firms. Okay. And the expected coefficient is positive, which is exactly what I find, it means that when value firms buy back more, okay, inflows to value firms are greater compared to those into growth firm. Okay. And if I decompose repurchases by value versus growth, you can see that when growth firms buy back a lot, it means outflows, relative outflows from the value firm, because share repurchases by growth firms will predict inflows to growth firms more than value firms. Okay, so the expected sign of the coefficient is negative. Okay, and what I find is that for this, I'm looking into flows, okay, to value minus growth. But if I look into performance of the HMF, traditional HMF factor by Fama and French, I find that there are price pressure implications. So if you look into the last column, okay, when buybacks are driven by growth firms, okay, it is negatively related to the realized return of the HMF factor. Okay. And in fact, this HMF factor, I can construct it using all firms or even only focusing on non-repurchasing firms. Okay. And I think this version is the one I think this factor is constructed using only non-repurchasing firms. Okay. So it means that buybacks are affecting the prices of non-repurchasing firms, okay, that are classified growth firms as growth firms. Okay. So, and actually I'm focusing on recent periods only, okay, because this pattern doesn't really hold in early sample period from 1986 to, for example, 2000, because during that time, the amount of buyback was small, okay? And then actually buyback was driven by value firms. Okay, so this only holds in recent period from early 2000s to 2023. Okay.
Okay.
Yeah.
So
Yeah.
if I hear you correctly, it's less of a value influence and more of a tech influence. You know, these tech stocks tend to be growth firms. They're doing the share repurchases, kind of helping their own cause at the expense of value stocks.
Right. Yes. That's right.
Okay.
Yes.
Interesting.
And I think and I noticed that value is coming back in recent periods, right? I think that's what I hear from people. And I do think that my buyback mechanism is inconsistent with that, not inconsistent with that, because what I find recent period, okay, so it's actually hard to disentangle, but from like 2000, like 1 or 2, actually this trend, okay, has changed, because it used to be the large growth firms has been driving buybacks. Okay, so this is as a percentage of the total stock market value. Okay, in recent periods, buybacks have been driven by those oil companies or those banks, which actually are part of the typically classified as value firms, right? Okay, so it seems like maybe this the buyback mechanism is also playing a role in recent periods too. Actually, maybe it's helping the performance of traditional value. Okay.
Boy, I wish Ken Little had joined us a little earlier. He's the research director at Brandis, a very dedicated value firm. I wish he was still on the call, but a part of me thinks maybe some of the reversal there, this might be wishful thinking, is better capital allocation among these firms. The value companies are seeing if the prices drop, particularly like during the early COVID period. Hey, this is a great opportunity for our shareholders to spend some cash and buy back our own shares. That to me is a thoughtful use of capital versus, as JJ touched on or you touched on, hey, I'm going to start a plan to help with executive compensation, for example.
Yeah, I do agree. Yeah. So in that regard, I focused on non-repurchase firms only just for like showing my point that it's price pressure that's generating these effects. But I do also think that those prudent behavior by repurchasing firms has own effects too. It also boosts the prices of their own shares too. And that's also what I find actually. So at the aggregate market level, and there are buybacks, okay, that tend to boost other companies' share prices a lot. Okay? But I also do find that those buyback firms get also benefit too with the smaller magnitude. That's what I find. Okay.
Well, one of the things that really impressed me
Yeah.
about your work
Mm.
is the data set that you've created. I mean, to my knowledge, a data set on share repurchases doesn't exist. So I'm just wondering, with all the data that you've collected, when we say more recently, have you been able to break it out across value firms? Is it larger value, mid value? Is it in any of the sectors specifically that you talked about, like banks, or, can you get any more granular on what value firms are buying back shares? And when you say recently, what period that is a little more specifically?
Oh yeah, so what I had in mind was between 2002 and 2025. And during that time, I think it was a good time for oil companies, large oil companies, ExxonMobil and those companies. So those big value so the big oil companies were big players during that time. And I think also so those banks are typically regulated, right? So especially during COVID, they had little flexibility to do something about their excess cash, but actually in recent periods from 2022 or starting from 2023, those big banks have been major players. Yes, yeah, there's like well-known names. So I think investors have been really happy about it, and that's why value firms have been partly why value firms have been performing very well during that time. Okay. Okay.
Okay. Any other questions? Not all at once. Okay. What other slides do you want to hit on that we haven't hit on?
So I talk about most of the slides actually, but the only thing I want to emphasize is that the aggregate implication, because it's a very simple pattern. What I find is okay. So basically, what I do is very simple. I just run time series from 1986 to 2023 is a quarterly frequency. And the Y variable, you can think of this as market return, or I can also construct a market portfolio using only non-repurchasing firm, but it doesn't really matter actually. Okay. And the X variable is the amount of share repurchase scaled by the total stock market cap, lags total stock market cap. Okay. And I find that with this simple regression, actually, just works just fine. Because if, for example, if you look into market return versus, I never explain what GIV is, so you can just consider it as just aggregate repurchases because the results are similar with that. Okay. And share repurchases return predictability is very high. Okay. And if I only use one variable, okay, share repurchases, this is in-sample exercise, of course, but I get in-sample R squared of 5%. Okay. It's a very strong return predictability. Okay. And this means that $1 amount of buybacks raises the aggregate stock market value by almost $8, okay, which is very big. Okay. And it survives other return predictors like suggested in the literature, like for example, dividend to price, earning to price, book to market terms, all those return predictors that have been proposed in the literature. It just survives well. Actually, the predictability becomes stronger. Okay. So I wanted to highlight this result, and I also wanted to highlight that when I construct the market portfolio, even only using non-repurchasing firms, okay, results are actually still there, okay, still robust, even bigger actually. But if I focus on repurchasing firms only, okay, so now the market portfolio is constructed only using repurchasing firms, I still see return predictability, okay, but slightly less strong than before. Okay, so in terms of magnitude and also like in terms of statistical significance, but still there.
Okay.
Yes.
And again, if I'm reading this correctly, this really underscores your key takeaway, like slide 18 versus slide 20. The money that's going from the share repurchase programs, it's going back into the market. It's boosting returns. If I heard you correctly, $1 will boost by $8. And that's what, the following quarter?
The following quarter, yes.
Okay. And so the returns are really boosted for the non-repurchasing firms. I think it was 8 there versus roughly 6 here for the repurchasing firms. So it's helping the repurchasing firms. It's helping the non-repurchasing firms even more.
Yes.
And then what's the persistence on this? This lasts for X number of quarters going forward?
Oh yeah, that's a very good question. So I look into persistence, and surprisingly, they are not reverting back. Like if I even take a very long window, they don't revert back, and that's one major difference compared to the findings in dividends that the paper I mentioned earlier. Okay, the one big difference is I think they found that the price pressure get reverted in very high frequency. Okay. And they also find that dividend reinvestment affects the prices of aggregate valuation of the stock market at a very high frequency. So they could even capture that with the daily data, I think. Yeah. But mine is much more lower frequency, quarterly, and there's no reversal at all. I don't find any effect of reversal.
Okay. Well, hey, Kim, thanks for jumping back in. See, you got your hand up. Question, comment?
Yeah.
Hey, you just went back on mute.
Yeah.
Can you hear me?
Now we can hear you. Yeah.
Okay, great. I'm sorry I've been in and out a little bit, so this question may have been asked before. Like I'm an old-fashioned fan of a dividend because I get it myself as the investor and I get to put it in my pocket or I can reinvest it in the stock myself and own more shares myself. I'm not a huge fan of share repurchases, and partly because a lot of them historically have been used to cover companies issuing stock options. But more recently, a troubling development, and I'd love to know your view on this, is that I've noticed that firms will announce major share repurchases, and they go out and they actually do it. But from an analyst perspective, the stock pops, and people get enthusiastic, and they think they're doing really fantastic capital allocation. But I'm disturbed because they're often doing it when, in my mind, the stock is pricey. And I'm not sure that in the long run, it really is additive for me as an investor, because is that the best use of their funds? Should they not have been investing in more machinery and equipment or development that would have progressed the firm further in the future? They're just doing it for short-term gains for the benefit of management incentives. So that's a long question, but that's my overall concern on this, and I would love to know your views on that.
I see. So I had one clarification question. So you said they announced when their valuation is pricey. Is it what you observed in the recent data? Because what I find is that so historically, I have another paper on buyback announcements. They tend to announce buybacks when the stock price is performing very poorly in the last, I don't know, like 1 year or so. Okay. So is that the recent finding, what you observe in the market?
It's
Yeah.
it can be, yes,
Yeah.
because there seems to be this knee-jerk reaction
Mhm.
in the marketplace to like, this is a good thing.
Oh, yeah.
And it's to my benefit, and it isn't always, and that's why I'm I think it's a trick that people are using now.
I see.
That's what my concern is, and whether you've done work and research that supports that. Like, is share repurchases in the long run more beneficial for investors than receiving a dividend?
I see. I think I misunderstood your question earlier. So thank you for clarification. So yeah, that's a big debate. And I have I can share my own naive view. Honestly, I think they are not doing things that are very wrong to investors, because like in general, I think there are some misalignment of interest between executives and shareholders. And I think maybe shareholders are sort of deceived in the sense that they just blindly think that share repurchase is a good thing, and then they just don't understand what's going on behind, because management has could have used the capital more efficiently, like you said, investing more in R&D or capex. But my view is that like those buybacks are driven by very mature, very old companies. So naturally, they don't have more investment opportunities than those smaller firms. Okay? And the more of an issue is, okay, so executives have even worse use of capital than this payouts. Like, they can use this for, maybe they can buy another corporate jet or something like that, right? That actually doesn't happen in the US anymore, because, it's a very mature capital market. I'm originally from Korea, okay? And that's why it was sort of a big issue in Korea. So I think paying out cash to investors is a good thing in general, okay? But I could understand that there can be some concerning, things about, okay, so maybe they could have used capital into longer term investment, or like, investing R&D, or they could develop drugs, or Apple could have, used the money to develop something even, greater than iPhone or something like that. Yeah, I agree. And I actually talk about this other paper showing that there's evidence that firms forego profitable future investment because they simply want to buy back their shares, just, option related reasons, compensation related reasons. Okay. So that is actually happening. Okay. So that is actually hurting long-term shareholder value in that sense. I do agree. Okay. But sorry for this very long answer, but there's one interesting thing about this buyback effect that I document. Okay. At the aggregate, it means that capital get reallocated from big mature firms to smaller growth firms. Okay. And this is actually kind of helpful for the aggregate stock market, because those younger and smaller firms are financially constrained. Okay. And if this buybacks actually boost the prices of other smaller firms, okay, it could be good news for those shareholders of the small firms, okay, and because now they can relax their financial constraints and invest more than before, okay. And some sort of unintended consequences of buybacks could be there as well. Okay, hopefully I answered your question. Yeah.
Well, it's I do appreciate the comment that there is some statistic that it is not always in the best interests of longer term shareholders. And to me, that's a very important segment of research that I'd love to see more of it on. So thank you.
Yeah, thank you for the question. I would love to work more on that, actually.
Yeah, Kim, thanks for the question. And your question triggered a few more that I've got.
Okay.
But I'll pause there if there's any other questions that we want to tackle. Dr. Mullins, thanks for joining us.
Hi,
Willow,
yes.
got a question.
Hi, Byungwook. So this is a great paper. I'm
Hi.
sorry I arrived a little late, but well, as I was reading the intro, I kept thinking, yes, this makes sense. Yes, this makes sense. Nice granular instrumental variable to pull out correlated shocks. And so my question is really like a simple one. What's the alternative hypothesis? So can you give us like what would have to be true for your results not to hold, for the money not to be reinvested into stocks? Like, is this one of these papers where you're showing us something rigorously that we would have believed anyway, or is there really like an alternative thing that could be happening that we're ruling out with this paper? Both of them are valuable. Both of them are super valuable. That was a question that I had.
Yeah, thank you very much for the question, because I really wanted to cover the slide, but I thought I was going to, but thanks for your question. I'm going to cover the slide. Okay, so what are the alternatives? Okay, so at the end of the day, repurchases are decisions by firms, right? Okay, and firm decisions always contain information, so there can be a lot of alternative explanations of what I find. So if you think about the reason behind why firms buy back a lot, okay? One simple reason, maybe they don't have good investment opportunities, right? Okay. Another reason is, okay, so maybe today's discount rate is very high, okay? So previously, profitable investment opportunity is not profitable anymore, okay? And high discount rate today will, of course, predict future, the return, okay? And also you can imagine that, okay, so when firms are really good at identifying mispricing opportunity on their own shares, right? Okay, or even at the aggregate stock market. Okay, Irvine has a paper on that. Okay, so if many firms buy back today, okay, it signals that today's market valuation is too low. Okay, if today's market valuation is too low, if it is underpriced, okay, then obviously it should predict, stock market return as well. Those are like obvious alternatives, like, and anyone can easily imagine.
Yeah, so sorry to interrupt, but I completely buy the need for your granular instrumental variable. That's not really what I'm wondering about. I'm wondering about, you show that the money from repurchases flows back into stocks in the same style bin, in fact. Yeah. Instead of going to bonds or to different style bins. That seems very reasonable to me. And so my question is, what would be the alternative? What were you thinking, like, where could it have gone instead of the same style bin, the same asset class?
Oh, I see. Your question was about flows, right? You think that's quite obvious. I see.
Yeah, I mean, it's important to show. I'm not saying it's not important to show, but like, or am I missing some alternative? Like, were you thinking, oh, actually there is rebalancing across asset classes, or should it be, put straight back into the same stock? I'm just not sure if there is a big reasonable alternative.
Oh, yeah. So alternative is people just consume more. And I think that's sort of the narrative shared by policymakers and regulators in the media, and they kind of think that, okay, so buybacks are payout and the payouts get consumed. Okay, so
not reinvested. Okay,
yeah. And also it could happen to other asset classes too. Like there's some paper showing that dividends, some amount of dividends get parked into bank deposits, for example. That could also happen. So alternatives are like, even also other asset classes, right? Maybe they could invest in corporate bonds or something else. Yeah, thanks for the question.
That makes sense to me. Thank you.
Yeah.
Thanks, Will. Thanks, Byung. I got two other questions, but again, I'll put them on pause if there's others from the group. And my first one, I'd love to invite comments on, because we've kind of touched on this, the notion of dividends versus share buybacks and the market's reaction to that. And my sense is I almost look at dividends like your salary. People expect to get it every quarter, let's say, and a share buyback is like your bonus. So if companies announce, hey, we're going to cut our dividend, and I know there's research on that shows often that's actually thoughtful, but the reaction among investors is, oh my God, something's wrong, and the shares sell off. And again, you kind of hinted at this, but maybe just confirm it with a share repurchase program. Again, it's more like a bonus. Hey, there's excitement around it. But if it's not there, there's less concern. Is that a valid sense of investor perception. Whether Kim, you want to address that, or anybody else wants to jump in.
Yeah, I actually want to hear your thought on that. So I personally think that, like, there are different groups of investors who like dividends and who like repurchases. But if that type of behavior is shared by the same investor, I personally don't fully understand, because I don't think there's a reason why dividends should be treated as my salary, because it can be always flexible, and I'm not fully sure why some component of payout should be considered as my like fixed income, versus some components should be considered as the bonus. I always get puzzled by that, actually. So if you have any better thought on that, I would really appreciate it. Yeah.
Yeah, I'm
Yeah.
in the same
Yeah.
boat. And
Okay.
I mean, there's all
Yeah.
this behavioral stuff. People
Yeah.
don't act rationally when
Yeah.
it comes to
Yeah.
money. Maybe that's part of it. I don't know. Just kind of speculating. Any other thoughts or is it just investor irrationality? And then, hey, on maybe the last question that I've got is, and we touched on this in the student paper again that's on the site, is what's happening in the U.S. with share repurchases. And Byung, you mentioned you're from Korea. What's happening, if you can speak to it, in other parts of the world?
Yeah, so I can speak to that. Korea is an exception, because investors are worried about firms not paying out at all. That's like a whole different issue. But I think repurchase is more of a US specific thing, but things are changing over time. But until now, European firms have been relying on dividends much more than repurchases. But repurchases are gaining more popularity these days, but still smaller than dividends. And I think that's also true in Japan too. Some Asian Pacific countries, dividends are much more popular than repurchases. But I think the other countries are also catching up recently. Yeah.
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 Agreed. And it seems what I've seen in the news and with Japan, maybe adopting a little more of a Western style approach to cash management, if you want to call it that. And when the center was part of Brand the Firm, we did a piece. Barry, maybe you can help me out with my memory on specifically Japanese, I think, pharmaceutical firms, and how much cash they would carry on their balance sheets. And you had all these overtures among Western shareholders saying, do something with the cash, at least pay it out. And management was like, no, we're not doing anything with it. But that seems to be changing finally in the last maybe 3 to 5 years.
Yeah. I'm actually familiar with that. So I think the ownership structure is very different. I think it's very concentrated among like families. And they think that, oh, we need this financial flexibility because we really do care about long-term investment, right? And then whenever something, there are always uncertainty, and we want to be well prepared for that. We're not necessarily hurting, shareholders. We want to be very well prepared for any uncertainty or any, some, unprecedented, situations like COVID or something like that. Yeah.
Yeah. Barry, any other thoughts?
No, I do remember that study, but it's a good answer, and things change, right? It changed a bit since then.
Yeah.
Yeah.
Okay, we had a few people had to drop out. Christian, I'm so glad he joined us. He was loving this, but had to go. Any other thoughts? So we can wind it up. But really good discussion. But before we do, any other thoughts, comments, questions? We give you lots of additional homework. Can you look into this? Can you look into that? Can you do this?
that's great for me. There are more things to do, in the future.
You just keep hanging out with us.
Yeah.
Hey, the only other question, and then I promise this is my last one. Did you, from what I remember reading, you're looking at retail mutual funds to
Yeah.
gauge the flows, and with a number of institutional investors on the call, Jim Harrington, Kim, and others. Do you think that's an accurate assessment? Getting institutional flow data might be a heck of a lot tougher, of course.
Yeah. So that's a very sharp question. So so that but I do find that the reinvestment between retail and institutional investors seems to be it's not that retail investors are rebalancing more than institutional investors, because I could infer that indirectly because the ownership structure doesn't really change around buybacks. So it implies that both of them are doing something similar. But I focused on retail flows only because they are observable. But it seems like according to changes in ownership structure using some regulatory data like the 13F, like for example, I don't see much ownership change around buyback. So it seems like investors are doing something similar. Yeah.
Well, hey, any closing thoughts? Any one last sentence? Say, hey, Bob, if you remember nothing else from my paper, it would be this.
It was to me, right?
Yes.
Oh, yeah. Okay. Yeah.
You can
All right.
defer to somebody else.
Yeah. All right. So I think I could. I have trouble getting back to the last slide. Oh, it's funny why that's the case, but I can actually go back. So I think my paper is very simple. I started from this question that, okay, so where does this cash ultimately flow? And it's an open question, and I like the question that what's the alternative? People think that, okay, so this could actually make wealthy shareholders consume more, than they can maintain more luxurious life with this higher consumption, or it could be used as something somewhere else. Okay, and I investigated this question empirically. And the only two findings I have, my paper is very simple. I find that it ultimately flows back to the stock market. Okay, cash get recycled in the stock market, so we shouldn't be worried that much about cash flowing out of the financial markets than some people think. Okay, and I also find one interesting implication about the price pressure on repurchasing firms. Yeah, I thank you very much for your engagement and comments. Those are very, very helpful to my research.
Good. Well, it's a two-way street. Thank you. Thank you for joining us and sharing more about your work. Looking ahead, as I mentioned, nothing on the short-term horizon. Our next webinar is going to be a publicly available webinar. The value investing in the high-tech age, I think we're calling it, featuring Brent Fredberg, who works at Brandis Investment Partners, Robert Hagstrom, and Adam Cecil. You'll see more about that in the coming months, but take a little break for a while. So, Byung, thanks again for joining us, and everybody, thank you. We'll see you again sometime soon.
All right, thank you. Stay in touch.
Thank you.
Bye.